Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Michael Opp, who's the founder of Opp Financial, and we'll be talking about purpose versus performance-driven accounts. Michael, welcome back to the program.
Thanks, Mike. Glad to be here.
Hey, so I like that title of what you want to discuss today, because purpose versus performance. You know, it just really gets down to the why behind what you're doing. So I'm excited about diving into that. So let's talk a little bit about what is purpose versus performance regarding investment accounts.
Yeah, absolutely. This for us has kind of been a resonating theme to really kind of define with our clients and new investors of what is this money for? And so let's talk about, first of all, purpose money. When you take a look at your money and you're trying to devise an investment strategy, it's important to say, okay, I've got money that needs to have a purpose. And that means that money is obligated to a bill, right? It's obligated to your mortgage. It's obligated to paying for insurance. It's obligated to something. So that means that money, right? It has it's purpose driven. So we need to make sure that there is a guaranteed income for that purpose money, that's covered, right? All your bills, your expenses, those things that have obligations to, whatever it is, your living expenses, that money has a purpose. Now, the rest of your money, that is performance money. Now, with that money, okay, it's not obligated to something. So what does that mean? That means that you can grow it, you can spend it, but really you have the opportunity to have more what I call latitude with it, whether it's growing it with risk or growing it without risk. There just is two different types of money that you have that we really feel that it's important to position in an investor's mind. What is this money for?
It kind of would relieve a little bit of the stress if you knew that one, quadrant of your money is there to accomplish this need, our living expenses, for instance. That's the purpose of that. But this other little quadrant of X% of your portfolio, if there's a little bit more volatility or risk, yes, we don't love it, but it's not going to impact our standard of living. And I think that would be a neat feeling to have set up for a client, right?
Absolutely. I think that when we have that discussion and we're doing this discovery with, clients or, new families and businesses that are coming to us, that theme really resonates with them. Like, oh, okay, that makes sense, right? So we can segregate it, because if you throw all your money in performance, right? And then you have the gyrations, the market drops 20, 30%. Well, what about your bills? Right? Now you have less money in that pot. So if you can segregate it, purpose money that you've got obligations to, that's where that money goes. Performance, you can grow it and you don't have to worry about the gyrations of the market. That seems to give our clients a lot more peace of mind when we're going over financial plans.
Yeah, I agree. Hey, can you explain what a fiduciary is? I feel like that word is something that a lot of times people bandy around and they don't really understand what the full impact is. So what is a fiduciary, and why is it so important for individuals to understand and consider when choosing a financial professional?
Yeah, absolutely. So, fiduciary is basically, an advisor has to pass a test. It's called your Series 65. Okay. And 3-hour test, but really what it is, it's a test that is going to ensure that your advisor he makes an oath or she makes an oath that you're putting the client first, right? So when you're named a fiduciary and you accept that role, by law, you have to manage the person's money for their benefit, not for yours. And so, this is a license that, I first acquired in 1997, and it's really evolved over the years. And I think if you watch TV, you see the advertisements, a lot of different companies say, hey, we're a fiduciary, and we put you first, we're on the same page. But again, I think you need to expand on that, because there's also a difference between what we call a captive fiduciary and an independent fiduciary. Let's talk about the differences. When I first got my fiduciary license, I worked for some large wirehouses, right? And so working for them, you go look at their product mix, you go to the cupboard, and you have a certain amount of investments that are available. Okay. And what I found is when I went independent, created Up Financial in 2004, that I was actually missing the boat. There was this whole universe of investments out there that I had no idea about. It didn't even exist. Those products, those things that could have helped my clients, could have helped them through the 2000, 2001, 2002 crashes. They were not available to me, Mike. They weren't. And so what I realized is that when you work for a captive fiduciary, guess what? If you look up the role of the role of a fiduciary for like a publicly traded company, they have a oath to the shareholders, right? And so it's kind of a conflict of interest in a way, because you're told to do what's right for your clients, but you're also answering to managers. You're answering to publicly traded companies that have
shareholder.
Yes, exactly. And so inherently, that's where the conflict exists. And so that's when I realized that, if I really am going to do this, after 7 years of being a captive fiduciary, I became an independent fiduciary, and it really opened up the whole universe of investments so that I could really do what's in the best interest for the clients. And that's where things really started to change. That's where, again, I became really what I would call a comprehensive planner, not just your captive agent, whether it's at a Fidelity or a Merrill Lynch or Prudential, something like that. Big difference.
Yeah, exactly. Just opens up a whole universe to offer your clients. It makes me wonder, can you think of an example of maybe a type of product recommendation that a client would get from a captive advisor versus what is opened up with what you can provide? Just some ideas, not specifics.
Yeah, no, absolutely. So, my brain really started turning in about 2003 when I was working at a firm, and I had a guy come into my office. He was sort of a wholesaler, and he happened to tell me, he said, was asking me, what kind of business, what kind of things I work with. And I'm like, well, bonds, mutual funds, stocks, kind of your typical things. And he said, Mike, have you ever worked with hybrid investments? And I said, I don't know what you're talking about, Vince. I've never heard of it. He goes, well, these are the type of investments that, take the best of both worlds. They can get market returns when the market goes up, but they also can protect the client from losses if the market drops. And I said, well, can you elaborate? He said, yeah, I mean, basically, if the market goes up, your client will make money, but if the market drops, they're not going to lose. And, this was 2003. And I thought, what are you talking about? I worked at Prudential. I worked at Payne Weber. I've worked at these large firms. Come on, if that investment was out there, I would certainly know about it.
Yeah, too good to be true.
Right. And he's like, no, really. And so he started showing me this, and I thought, oh my gosh, how did I miss the boat on this? How did I not know this? And what I found is the firm just didn't offer it. In fact, I called a couple of my friends who worked at A.G. Edwards, that worked at Smith Barney. I said, have you ever heard of these hybrid investments? No, we've never heard of it. And that's when it was like an epiphany for me, Mike. I realized, you know what? If I want to do what's best for the clients, I better find an independent platform, create my own firm where I can do that, where I can offer the entire investment product universe for their best. I mean, again, for the needs and the best interests of my clients. And again, that's why I became an independent fiduciary and started Op Financial.
Yeah, that's amazing. It kind of makes me think about, the safety and security of a bank CD. Well, that's fine and good. You're not going to lose money, but if the markets go sky high, your rate of return doesn't change at all. Well, then you compare that to, let's put our money in whatever fund in the markets, and if it goes sky high, you benefit from that. But if it crashes, you take a sock to the gut. So what's the nice hybrid is what you just described. You benefit when the markets go up, but you can't lose money. And I would venture to say that just gives people such a nice peace of mind aspect.
Yeah, it really does. I mean, you're getting the best of both worlds, and really where this is so beneficial is, again, when we're in these inflationary times that we're in right now, Mike, people are not just worried about protecting their principal, but they need to keep up with inflation. And so if you're relegated to low interest rate investments, whether it's CDs or money market, you're losing money every year, right? You're losing every year. And so you have to find ways to keep up. And so these hybrid type of investments that they're offered through insurance companies or even large financial institutions, boy, I'll tell you what, they really have been a game changer for our clients. And when I look back to a market that is eerily similar to what we're seeing today, back post 2003, if you look at from 2000 to 2011, really the S&P 500, if you look at it, really didn't do much. If people were invested in that period of time, the market went down, it went up, and it was this big up down zigzag. And at the end of that 10 years, you might not have made a dime, but we were able to, for our clients, average 5 to 7% during those tough time periods using some of these hybrid investments. And it was a game changer for our clients who are in retirement or about to retire.
I love it. Well, let's wrap up with this, Michael. I know that we were talking about purpose versus performance. And I think a lot of times people might think, if I had a full-on portfolio focused on purpose driven accounts and then another portfolio of performance driven, how do they compare to each other? And I would venture to say that you would respond and say they don't compare because they're two different purposes. But just talk a little bit about an example or maybe case study of how you would make that recommendation to a client for protecting their retirement investments.
Yeah, absolutely. So again, as fiduciaries, look, we work with a wide array of investments. And again, we're not, one thing is we're not cookie cutter. And so as a result, we take a look at each person, each family independently, okay, based on age, risk tolerance, things like that. And so when we're starting with, okay, square one, we need to know what are your needs, right? What is the absolute, what's your purpose money? Okay. How much do you need per month? Okay. And so when we start there, we know, okay, we can cover those needs. Now, performance money, not be money that we need later. Maybe, for medical expenses down the road. Maybe you're looking to plan vacations. Maybe you want to leave a legacy to your children or to families. So that's money that, that's money that's, later, it's got some time frame. And then from there, with that performance money, we need to determine, okay, well, how do you want to manage that? How much volatility do you want? Do you want growth with no risk? Do you want growth? And so, again, those conversations through the discovery process that we use, we're going to fine tune that for you so that we get an exact, what I call an exact estimate of what you need, when you need it, and then we're going to show you how to get there.
Yeah. And guess what? That exact formulation and structure and template is not the same for everybody. So it is definitely something where you are going to sit down and understand what that client needs, make your recommendations, and see what fits their needs best. So I think that's what most people get frustrated if they go to an advisor and go, "Oh, nice to meet you. Here's what we offer," and it's like you didn't even hardly ask me anything. So that's a big point.
No, and again, just to expand on that, Mike, I can't tell you how many times like we have seen portfolios literally that are 100% identical from these same financial institutions that advertise on TV. And whether the client is 40, whether they're 60, or where they're 80, it is the exact same. In fact, we recently had a conversation with a lady and her daughter out of Arizona, and the mom was so frightened about risk. And when we did an analysis for a portfolio, we're like, gosh, you are so risky that you could lose 30, 40% of this in your 80s. Is that what you intended? It's like, no. So I said, well, let's talk with your daughter about this. And the daughter said, yeah, it's really been bothering me because, I can never get an appointment with her advisor. And so when we do, her advisor just, oh, you know what? Markets go up and down. That's just what it does. Well, yeah, they go up and down, but it's about what does that client, what do they need? And if they don't want to lose, my God, they shouldn't be getting it.
Yeah. And you shouldn't rubber stamp cookie cutter template the same mix portfolio for every single client, because that certainly cannot be the case. So I would say this, Michael, that you would be probably thrilled to give a second opinion to anyone saying, take a look at my risk portfolio, my, layout, and see what is best for me. So if someone is interested in learning more, how can they do that and also reach out and connect with you?
Yeah, absolutely. And I think, if you want another, what I would say assessment, take a look at really where you are. Reach out to us. In fact, you can reach us by phone, and that would be 720-989-4295. Pop us an email at michaelopp, MICHAELOPP, @OppFinancial, or just visit our website at oppfinancial.com, and you can schedule an appointment there. But again, probably the easiest way is just reach out direct to us via that 720-989-4295 number. And let's just see what's going on. Let's look underneath the hood and see what kind of risk you're taking, because I can tell you, we took a look at a client who said they don't want to lose money. And we looked at something for them and said, gosh, not only could you lose money, but based on where you're invested right now, if the market drops, you're going to lose more money than the market. You have something called a higher beta, which we can explain. But again, call us, reach us at those numbers, and we'll be happy to just, give you another look at what's going on there for you.
Excellent. Well, Michael, thank you so much for coming back on. It's been a real pleasure talking with you.
My pleasure, Mike, and look forward to our next conversation. Thank you.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneursradio.com.